The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in a frigid New York, I'm Scarlett Fu.
And I'm Bonnie Quinn. We are kicking you off to the closing bell. So, Scarlett, let's have a look at how we are faring in these markets. Right now, we are negative, but just barely, and that's been the way it's been for most of the day. Don't forget, the closing record for the S&P 500 is 6118. We're really only 4 points away from that. Meta dragging on the indices today, and you can see that in the Nasdaq 100 as well, down just fractionally as well. The 10-year yield up about 6 basis points. A fascinating whippy 2 weeks for the 10-year yield. That curve re-steepening today. We have hotter than expected, obviously, CPI figures contending with more than decent growth. And of course, we had Fed speakers today as well, from San Francisco's Mary Daly right to the governor, Chris Waller, saying that we're going to be on hold for longer. Bitcoin took a leg lower in the lunchtime hour. It was interesting. It was well below $94,000 a coin. We do seem to be recuperating just a little bit, but we're still negative in the last 24 hours by 2.5%, Scarlett.
All right, well, to put it into context here, an extended stock market rally is losing some steam. Since the end of 2024, the S&P 500 has seemingly gone nowhere due to uncertainty over tariffs and what their implementation eventually will mean for inflation and interest rates. And that has left the benchmark index hovering near its record high for weeks. And according to Bank of America, investors are long stocks and short everything else. Treasuries also stuck in a range, with the bond market on edge about economic growth and a need for safe havens balanced by fears of quickening inflation. Now, tariff concerns have taken a backseat to geopolitics this week, with top officials from the U.S. and Russia meeting in Saudi Arabia today to reset bilateral relations. On the agenda, laying the groundwork to end the war in Ukraine and boost economic ties. European leaders, they're left to watch helplessly as traders assess what the talks mean for the region's natural gas and European defense contractors. Now, back here at home, home builders are feeling less confident as persistently high mortgage rates and the uncertainty of tariffs clouds their outlook. After the market closes, we're going to hear from Toll Brothers to give us a real-time check of how much increased costs and incentives are taking a toll on profitability. But in the meantime, of course, we have a lot of news to get through.
Well, and of course, that 30-year mortgage rate was below 7%, just a few basis points lower than it has been, but it has this chart to thank, right? I could look at this all day. It's just been so fascinating how many times the markets have been repricing interest rate increases and cuts and increases and cuts. Well, right now, for the end of the year, we are fully priced in with 1, and there's even odds that we'll get 2, and that's just for right now. We'll see what the next few weeks brings. It has been a very whippy 2 weeks for that 10-year Treasury and that market expectation, Scarlett.
All right, Bonnie, fantastic roundup there. Let's kick things off now with Stephanie Aliaga, global market strategist with JPMorgan Asset Management. And I think Bonnie put it really well, which is people have been pricing and repricing how many rate cuts we're going to get this year. We're not going to get a definitive answer from the Fed anytime soon. They want to see a lot more data. So what do investors do in the meantime? How do they position for now?
The Fed has made clear, really the first analogy in December of last year, that we're in the midst of this economic fog. We're smack dab in the middle. The Fed's going to wait things out. Investors should likely wait things out before making any major pivots in portfolios in response to recent trade actions. But in the meantime, check your headlights, check your brakes, check your exposure. And particularly as market performance year to date has showed, diversification is really the theme this year. And it's not only about risk management, it's also about taking opportunity or taking advantage of the broadening opportunity set in front of investors today. So I think that's the key action item.
So, Stephanie, when you say wait it out, what are we waiting for exactly? Are we waiting for the economy to break or for inflation to give way?
I think we're waiting on just better clarity as to the mix shift of different policy actions we're going to see. We've seen a flurry of tariff announcements, but we need to see what actually is enacted, what lasts, what trade deals are put in place, and then everything else on the agenda, on immigration, on tax cuts. The mix shift of all of that will ultimately move the dial on growth and inflation. But in the near term, we might want to pay close attention to business sentiment, because the storm in and of itself can have a toll on growth. And that could be if, businesses start delaying capital spending plans, which is one of the things that's actually driving the economy right now.
Yeah, and it's something we've been listening to very carefully for during the earnings conference calls this past earnings season, and it's certainly raised a lot of questions. So what if you have money that you need to put to work? There are a lot of people who are rushing to put money into their Roth IRAs, for instance, before April 15th, and they got to put some of that money to work, presumably in equities. Should they be getting into tech stocks, for instance, right now with valuations looking pretty toppy?
It depends on your current exposure. I think most investors that have already been allocated and invested in U.S. equities probably already have a good allocation to U.S. tech, and particularly just a few names. So I'd say think more holistically, leaning into value, leaning into other parts of even the market cap spectrum, leaning in internationally as well. We've seen that the zig and the zag with U.S. and international stocks has been in play this year. And so more holistically thinking about that diversification argument seems to be the case. I wouldn't say investors should wait and see in terms of putting money to work. We still feel risk on about the markets. There's a fog, but the object set in motion can remain in motion if this fog just dissipates. And the object in motion is still one of a pretty robust outlook for growth.
You mentioned business spending plans, and we're obviously seeing huge spending plans from the mega businesses, right, on AI and research and development and so on. If you look at what small businesses are planning on doing, it's a very different story. We have a chart here showing that the 3-month lead is much, much lower than what they're actually spending on CapEx right now. That is not a good sign, is it?
It's not. It's one of the early warning signs that we want to pay close attention to. Now, the biggest spenders in the economy are not the small businesses, but really the big businesses spending the real $100 billion on CapEx, particularly around AI. But if that sentiment really broadens out, that's a real risk for the economy.
Where do you want to be when it comes to fixed income? Bonnie talked about the yield curve re-steepening a bit here, and we know that when it comes to credit, for instance, everything's priced, it feels like to perfection. Spreads are so thin.
Spreads are thin. There are risks that will likely keep the long end of the yield curve elevated, particularly as we get into the fall and we start talking more about the reconciliation bill and these concerns around the deficit start to bubble up even more. So with that in mind, I'd say stick to the short to middle part of the curve. But with that said, fixed income is attractive for investors today because of its fixed income, and higher yields do provide a really good dose of stability to fixed income portfolios that really hasn't been there in the last 2 years.
What about other kinds of diversification? We're obviously looking at Gurman with a new target for gold now,
yes.
right? And then Bitcoin has been on some wild ride recently.
It has. Yeah, I think, look, the investment menu in front of investors today, it's not the 60-40, just stocks and bonds. You're talking about alternatives, newer asset classes. I think taking a really broad stroke as to what diversification means makes a lot of sense. Gold has been a big beneficiary of both secular demand drivers, but also the fact that inflation is coming down and gold is a safe haven asset.
But would you have it as just a little corner of your portfolio, or would you make some of these alternative asset classes now something a little bit more real, more meaningful in your portfolio?
I think in any portfolio, you probably want some kind of allocation to alternatives. With gold, I think there's been some real drivers in place there, but gold doesn't pay you any income. It doesn't earn any earnings. I'd say we feel we have higher conviction, I think, on other alternative assets, areas like infrastructure, like real estate, that can provide greater stability from both income and capital appreciation over the long term.
How much conviction do you have in the European stocks trade? The European stock market has done much better than the S&P 500 this year. Defense contractors are definitely getting a second look because they're going to see a lot more business if the U.S. continues to move in the direction it's moving in. And natural gas futures are certainly in the spotlight with the talks to end the Ukraine war.
On the defense side and the geopolitical side, things are moving quite quickly. I think the story here with European stocks is that everything has a price, and European stocks had gotten incredibly cheap. And now we're seeing some of those differentials really narrow, perhaps. And
Still cheap, though?
Before recent performance. But I think the other key point here is despite the tariff talk and some of these risks on the global front, there are going to be winners and losers however the new alliances and kind of trade deals are drawn. And so it's hard for markets to really size whether Europe is a loser in some of these trade talks or not. And in the meantime, I think you have some of those other tailwinds at play.
All right, Stephanie Aliaga, global market strategist with JPMorgan Asset Management. Thank you.
Thank you.
Such a pleasure to have you on set with us. All right, coming up on the close, move over SPY. There's a new ETF in town. We're going to break down how Vanguard has officially unseated State Street for the title of the world's biggest exchange-traded fund.
Plus, speaking of picking stocks, a conversation with the man Bloomberg calls America's best stock picker. How Adam Benjamin's mutual fund at Fidelity has beaten the market for the third time in 4 years.
And Kim Kardashian, she is just doing it. How the pop culture icon's latest Skims collaboration could help out one of America's biggest athleisure brands. We've got all that and more coming up. This is The Close on Bloomberg.
So... Vanguard has unseated State Street as the world's largest exchange-traded fund. Vanguard now holds roughly $632 billion in assets after bringing in about $23 billion so far this year, allowing them to hurdle past State Street for the title. Joining us now is Eric Balchunas, Senior ETF Analyst for Bloomberg Intelligence. Eric, it really all comes down to the fees, right? Vanguard just slashed its fees to something like 7 basis points versus, what, the average of 40 basis points?
Yeah, I mean, that's Vanguard's overall asset-weighted average fee is 7 basis points. It's really an investor utopia out there now. I mean, you can get almost anything for, under 10 basis points. But VU is 3 basis points, so it's even cheaper than their average. And SPY has been 9 basis points since it was incepted. So over the years, I think this move here is, they both have a ton of assets, but VU taking over SPY to me symbolizes the real adoption of ETFs by advisors and retail. Those people go in long term and they love cheap fees. SPY is more liquid, they get the trader crowd. But more and more advisors and retail are using ETFs for long-term solutions. And Vanguard obviously is probably the number one name in that. So it's kind of symbolic, I think, of how far and wide ETFs have spread amongst the advisor and retail community, even though they were invented by an exchange to try to get institutional trading.
So SPY and VU cater to different audiences. What do the flows show about how hedge funds and traders are using SPY versus how mom and pop retail investors are using VU?
Yeah, this is an interesting question because most of the assets in VU are retail and advisors. They're not moving around much. SPY has, name an institution or retail, sort of a professional type of investor, and they're probably using SPY. Over the years, though, what happens is people do move over. IVV is also in the mix, by the way. You'll find people who love the liquidity of SPY being like, well, VU trades $2-3 billion a day, and that's good enough for me. There will be a point probably where VU trades more than SPY too, but that liquidity, like overcoming that, is going to take probably 5 or 10 more years. But there will be a tipping point where VU probably will be the biggest and most traded ETF on the planet. SPY, by the way, has a ton of options activity. So all of that ecosystem, and if you're trading, the expense ratio isn't as important, right? It's spread out over a year. So if you're going in for like a week or a month, it's not that big of a deal. So hedge funds, institutions sometimes still use SPY despite the fee.
Yeah, how much, if you're an individual investor, are you buffeted by some of those kinds of flows, Eric? Or do these ETFs manage to mirror exactly what's going on in the index every single day?
Yeah, they've gotten really good at tracking the index. They basically have, the tracking difference would be about the same as the expense ratio, and that's it, no more for some of these. I do think, though, the flows are an interesting point. ETFs are interesting. You got institutions and retail and advisors all using the same ETF, getting charged the same fee. But they do benefit from each other. The more people that use an ETF, the lower the bid-ask spread is. And so, in a way, they kind of feed off each other. Even though they are totally different kinds of investors. ETFs are the first time that these types of investors are together. Mm-hmm. In mutual funds, they were always spread out with the institutional class or the A class, where institutions get separate accounts. ETFs, first time in history where everyone's in the same sandbox, and they do kind of benefit off of each other, which is a good point.
All right, Eric Balchunas, thank you as always, Senior ETF Analyst for Bloomberg Intelligence. And for more on ETFs and this store in particular, don't forget to tune into ETF IQ tomorrow. We've got an interview with Janelle Jackson of the Vanguard Group. And speaking of ETFs, Vani, there's a great story today about how popular YouTuber influencer had his own ETF called the Meet Kevin Pricing Power ETF. The ticker was PP. He's shutting that down at the end of the month. PP. I know. He made a big deal about that.
Well, he only chose around 12 stocks, right? But he struggled to make those 12 stocks profitable. I mean, it wasn't, timing-wise the best probably for some of these stocks. But, I was surprised that he had even $32 million left at the end when he decided to close it down. So many ETFs every year go out of business, Scarlett.
They do, and it all comes down to performance, right? If you are trailing the S&P 500, you're just not going to get the money, and you're not going to be able to hold on, and you're not going to be able to keep this fund going. And this is what happened. That underperformance was its death knell.
Yeah, exactly. And you have to wonder if it's a question of, well, I can teach much, but maybe I can't do, or maybe if you had more time, or maybe you'll start another ETF.
That's my guess. I'm sure some other idea that involves crypto. I don't know. I'm just speculating. Something will come up again. All right. We've got much more coming up. No. Toll Brothers shift to affordable luxury homes that may be weighing on pricing. We're going to preview what to expect from Toll Brothers when it reports earnings today after the market close. This is The Close on Bloomberg. It's time now for our top calls and look at some of the big movers on the back of analyst recommendations. And let's start with Hims and Hers. Morgan Stanley cutting its recommendation to equal weight from overweight. The analyst still has a favorable view of Hims, given its strong momentum from GLP-1 developments. But he says it's time the telehealth company take a breather after a torrid run. He also raised a price target to $60 from $42. Shares currently down about 2.7%.
Scarlett, I'm taking a look at DraftKings. A number of firms raising their price targets for the sports betting platform after last week's quarterly report. That includes a raise from $48 to $60 at Piper Sandler. January off to a strong start, and the analyst remains impressed by DraftKings' core trends and growth rate. He keeps an overweight rating on the stock. Now, shares right now are down 4.2%, but don't forget it did have a nice run up. It was up something like 15% in the Friday session.
All right, and let's end things on Bath & Body Works. JPMorgan's Matthew Boss lifting his rating on the candle and personal care retailer to overweight from neutral. Boss sees a fundamental inflection on both the top and bottom line and up to $825 million of free cash flow generation. Bath & Body Works reports earnings later this month. Shares up almost 8% on the day. And those are some of our top calls. And let's stick with the prospect of earnings because we're a little over an hour away from Toll Brothers' latest quarterly print. Revenue seen falling about 1.5% as average home sales prices hit a 2-year low. For more on what we can anticipate, let's bring in Bloomberg's Norah Mulinda, who covers the company. And Norah, one of the big stories here for Toll Brothers, just to take a step back, is its strategic shift to what it calls affordable luxury. Why is it doing this right now?
That's really been a push that we've been seeing across the board in the industry. People are really looking for affordability right now. Of course, there's high demand for housing, but there's also a housing shortage. And so when we think about this affordability or inaffordability crisis, rather, that's something that Toll Brothers, along with a lot of other home builders, hope to address. But what analysts are really expecting from this report is that unfortunately, its shift to affordable luxury could potentially weigh on its pricing power. But they do expect orders to climb in this previous quarter. But really the question is, how much demand was there really in this previous quarter with interest rates extremely high?
Right. They're looking for orders to have climbed roughly 20% in the fiscal first quarter, Norah, which sounds quite a lot, actually, given where interest rates are. What's driving that demand?
I mean, what's really been in focus for Toll Brothers, it actually was the second best performing home builder in 2024. So we do still see a record share of ultra high net worth individuals paying for homes, for expensive homes in all cash. So they're essentially bypassing this idea of taking out a mortgage and they're paying things upfront in cash. So you're seeing a lot of luxury home builders like Toll Brothers still building to hopefully meet that demand. But when you think about this shift to affordable luxury and you think about the middle class and people that are able to afford some of the lower price tag homes, there's not as much demand when it comes to the ability to be able to pay these sticker prices.
Let's talk a little bit about incentives, because this is what the home building industry has kind of relied on to make their homes affordable or increase the affordability of their homes. And of course, increased incentives will end up eroding profitability through the gross margin line. What do we know about what Toll Brothers has done when it comes to incentives and how it sees that playing out?
So analysts and investors are really calling for home builders more broadly to pull back on their use of incentives. So what a lot of home builders tend to do is they buy down mortgage rates. So if you have an average mortgage rate sitting at about 7%, they're actually buying that rate down to about an average of 5.5% for the average home buyer to make it a little bit more easier to take on a new mortgage and actually buy a new house. But that's really what investors and analysts on Wall Street will be looking for out of this print, as to whether or not they were actually able to decrease the amount of incentives that they were using in this past quarter, because that's, of course, something that can really weigh on margins here.
And then geographically, Norah, what are we anticipating? Last quarter, for sure, we heard that there was actually some weakness in the likes of Florida, which is maybe not something we would have expected post-COVID.
Right. There's definitely going to be a lot of attention on the southern states in this print and other home builders that are reporting, especially as we think about what construction could look like, with a lot of a pullback in undocumented workers potentially being having a larger crackdown on undocumented workers. So people are really concerned about how much that will weigh on the construction industry and, of course, what that means for home builders. So it'll be really important to watch what it looks like in these southern regions for Toll Brothers when they report today.
Yeah, that's a really, really important point, and it's something that I'm sure Toll Brothers is monitoring very carefully. They're affected by so many different parts of the Trump administration's policy priorities. What about Southern California? Because that presents kind of an opportunity for these home builders. Of course, not immediately, but down the road. Is there expectation that they'll be addressing this in a meaningful way in the call today?
That's what everyone's going to be watching to see whether or not there is a little bit more detail there. But I think the main concern out of this print is really going to be what their margins are looking like. When we think about home builders, the main metrics that we're keeping an eye on is gross margin, orders, as well as home deliveries. So those are the three metrics that will really tell the story of what this past quarter has looked like for Toll Brothers.
All right, Norah, thank you so much. Looking forward to those results post the closing bell. That is Bloomberg's Norah Mulinda. And Scarlett, I just want to point to a story that's crossing the wire just in the last few minutes. Silver Lake Management in exclusive talks to acquire a majority stake in Intel's programmable chips unit. This is according to people familiar with the matter, and it has Intel rising even more than it had been all day long, right?
Yeah, you can look at the intraday chart, and Intel up at session highs right now, climbing 16%. It was a big winner in last week's trade as well, gaining 24% for the previous 5 days. And a lot of this is all tied to this idea that Intel might be broken up, it might be acquired, parts of it might be acquired. There are different players, being thrown about as potential acquirers.
And we're kind of looking into the nuts and bolts of its business, right? So we reported last week that TSMC had discussed the idea of operating its factories and also having a controlling stake. And then the, CNBC report earlier on today that the chip design and marketing business may be bid for at least by Broadcom. So we're getting all of the little pieces of Intel here, perhaps being thrown about the S&P 500 universe.
Yeah, but are we curious to see whether the Trump administration allows a company like TSMC to buy an important stake in Intel? All these coming up, all these issues coming up.
A lot of unknowns. All right, coming up here, we're going to find out what's in store for the tech sector from America's best stock picker. Our conversation with Adam Benjamin of Fidelity Investments. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the Countdown to the Close. I'm Scarlett Fu.
And I'm Vonnie Quinn.
And we're looking at a market that's not doing much of anything right now. It's worth noting we have a holiday shortened week. A lot of people are off because their kids are off for this week as well. So volume is not as heavy as it normally would be, but there's certainly a lot of things to keep an eye on. And you look at the Philadelphia Semiconductor Index at session highs right now. You just told about the news about Silver Lake maybe looking to buy Intel's stake in Altera. That's maybe one of the drivers here, but this is an index that lost about 11% from the 22nd of January to the 27th and has since recouped a big chunk of that. DeepSeek certainly gave everyone a reality check, and now we're trying to figure out where things are with these chip makers.
Yeah, exactly, Scarlett. And if you look at the Philadelphia Semiconductor Index today, really most of the components in it are higher, and it's just fascinating. Maybe it's all in the run-up to NVIDIA earnings. That could be,
That'll
right?
be next week, right?
It's going to be next week, and it might be the next major catalyst for these firms. Given that today, I think some of what we're seeing as weakness is just Meta being down 3 to 4%.
That's a good point.
Well, taking a look at shares of Intel, because they're definitely higher. They're up by almost 17% now. An additional few percentage points on speculation that the U.S. chipmaker could be broken up in a deal involving TSMC and Broadcom. And we're just reporting in the last few minutes that the Altera unit might be bought by Silver Lake Management. It's an exclusive talks to acquire a majority stake in that programmable chips unit, according to people familiar with the matter. So joining us now with more on all of this is Adam Benjamin, Portfolio Manager for the Fidelity Select Semiconductors Portfolio at Fidelity Investments. His mutual fund produced a 49% total return in 2024, outperforming both the S&P 500 and the Philadelphia SOX index. So Adam, congratulations. Obviously, we want to keep things going this year, I'm sure. Should we invest in Intel right now?
Thanks for having me. Obviously, that's not a question I can answer directly, but what I'll say is Intel is a soap opera. It's a very complex story. This is something that's been in the works for quite some time. The company kind of fell off the manufacturing leading edge with 10 nanometer years ago. It's been struggling. It's facing a big challenge on its product side as well, as AI has sort of disrupted the whole dynamic for the data center. It shifted from traditional general compute, which is CPUs, which they sold, to accelerated compute, which is really toward these GPUs and accelerators that you've heard of Google selling a TPU or AWS with Trainium. So they're facing a really complex battle on both sides, both on their product side and their manufacturing side. You mentioned Altera. That's really just a sideshow. Their board has been meeting to sell off that business. They've talked about this publicly. It's a small business in terms of the greater piece. They bought the business for $16 billion. They'll probably sell it to private equity, as you mentioned. Silver Lake, somewhere less than $16 billion. I'm hearing about 10, 12, but it's a minor piece. The bigger part of this whole story is really the manufacturing piece and the geopolitical dynamic and the CHIPS Act of trying to keep or put some kind of leading edge manufacturing in the U.S.
So that being the case, this idea that TSMC could buy a stake in its factories at the request or invitation of the Trump administration, how would that fit in with this idea that you'd have a foreign company owning such a big part of its manufacturing capability? Isn't that something that we're trying to move away from, Adam?
Yeah, so I think it's a little bit misplaced what's been talked about. But, if I just go back, forgetting about my management of the fund, following the semi industry for 20 plus years, really late summer, I talked to a lot of industry people, government officials, and really was like, what is the right answer to fix the manufacturing business for Intel and how to, have some kind of self-sufficiency or sustainability on the leading edge manufacturing? Because as you indicated, TSMC, there's really three players, TSMC, Intel, and Samsung. Everyone else has really fallen by the wayside, including Intel and Samsung. So all of these leading edge AI compute accelerators and GPUs are manufactured in Hsinchu for Taiwan. Small little island. They're getting it up and running in Arizona. So we need to have some kind of alternative just in case there's a geopolitical challenge. And so really Intel has these facilities in Arizona. They're trying to build something in Ohio. The problem is their recipe, 18A, which is their manufacturing process, is not what any of these companies want. Everybody wants TSMC's process because that's what they're using in Taiwan. It's complex, but really what it is these companies have built a specific chip to a design to a certain process, and they're not going to just shift over to Intel. So the right answer is these potential facilities not owned by TSMC, maybe run by TSMC, and essentially using the TSMC process so that you can make something in Taiwan, you can make something in Arizona, you can make something here. There's a lot of details that have to be worked out here. And so I think, everybody just, slow down. This is complex. I know everybody wants technology to be solved like that, but the CHIPS Act wasn't solving everything. This is a long journey. And so, be prepared for the manufacturing side. It's going to take some time.
Adam, your Select Semiconductors portfolio has been heavily weighted towards NVIDIA. You must be waiting for the day when you wake up in the morning and you decide to change that weighting. When is it coming?
Well, look, I assess the portfolio every day. And so, what you're not seeing is, how we're looking at our individual bet sizes across the space. I think, the market really wants AI to happen tomorrow. This is a long journey. This is a really complex problem. I've been following the tech space for 25 years. It's the hardest problem I've seen ever. And so it's going to take time. Look at autonomous driving. Look how long that's taken to roll that out and be safe. and it will continue to evolve over time. So that's another example, as well as robotics, which you're going to see more and more of that coming up with GTC in March when NVIDIA does their big annual developer conference. So look, I think there's other ways to play this whole AI theme. You've talked about some of those names on the show. But I think overall, people need to realize this is a long journey, and AI and the infrastructure that's being built is taking time to build out. But I think there's a lot of interesting opportunities for the semiconductor industry outside of AI, right? You've been in this massive cyclical downturn. We had, COVID drove this massive inventory glut of shortages, which we've been sort of an overhang for about 27 months. And now we're, over 2 years into this inventory correction, and these broad-based analog players are starting to see a little bit of light at the end of the tunnel that serve broad-based end markets like industrial or communications, or the auto end markets. So there's a lot of opportunities in semiconductors. It's nice that everyone's excited about semiconductors. I remember when I first got into it, people just didn't, realize how important semiconductors was. But, it took a pandemic for people to get excited about it.
No, it did. And to the point where, life couldn't go on because we were so dependent on these chips that suddenly were so scarce. Adam, you mentioned that you've been doing this for 25 years, really digging into semiconductors, the industry. What is someone who isn't familiar with the semiconductor industry, your average investor doesn't really appreciate about the chip industry, what you've had to learn the hard way?
I think it kind of goes to the conversation we were having earlier on Intel. I mean, to put fabs up and to manufacture for other people, which they've never done before. They've only made chips for themselves. That's called IDM. They've never been a traditional foundry, which requires a whole different skill set. It doesn't happen overnight. Building these facilities. I mean, these things are as big as cities. And so I think what people underestimate is the time it takes to do this, the process, how long it takes to introduce a new chip. And, you hear people over and over again of like, oh, OpenAI is going to have a chip tomorrow and they're going to, compete against NVIDIA. And it's a lot harder than people realize.
Right.
And, AI is not just a chip problem. It's a whole infrastructure and compute problem, which is, really a data center problem. And it's a full stack with software, algorithms. And so I think people have underestimated the challenges with this, which is also making it, the barriers and the moat for some companies that have those opportunities way bigger.
Well, and Adam, that's why we need people like you to figure it all out and be able to articulate it for us. Adam, thank you so much for joining us. A pleasure speaking with you. Adam Benjamin of Fidelity Select. Now, coming up on The Close, Kim Kardashian's latest business venture involves her teaming up with Nike, and that is our stock of the hour. That's up next. This is The Close on Bloomberg. All right, Nike shares are moving higher on the heels of Nike and Kim Kardashian's underwear label Skims teaming up. The two are collaborating on a new fitness brand geared toward women called Nike Skims. This line will include apparel, footwear, and accessories, with the first collection set to debut in the spring. Joining us now to discuss this, Bloomberg's Emily Graffeo. So I didn't realize that Kim Kardashian does not do sneakers right now or footwear right now, right?
At least not under Skims. Yeah, so Skims is swimsuits, underwear, shapewear. And what has made Skims stand out is that Kim Kardashian has been very inclusive in her sizing and also the different shades of the various intimates that she supplies. So I guess the Nike collection will probably also reflect that commitment that she has.
Well, it's fascinating. According to one study, the athleisure market is $400 billion worth of market. So if you get a sliver of that, that's fine, right? So what does she need to do in order to keep that sliver? And what's in it for her?
That's a good question. What's in it for her? I mean, it's hard to scale a brand. And Skims is a direct-to-consumer brand. So you imagine that partnering with Nike is going to elevate that profile of the Skims brand. But it's also something that's good for Nike. If you look at what Wall Street analysts were saying about this announcement. Piper Sandler said that Nike Skims, which is the name of this partnership, is a red flag for Lululemon, and that this is moving Nike in a positive direction.
And I guess it fits in too with its pivot overall, right? During the Super Bowl, they had an ad where they were saying "Just Win." I think that was the name of the ad, right? In any case, featured all these top female athletes. I forget the tagline that they used, but they're definitely trying to portray a new vision as they move forward under the new CEO and former executive Elliott Hill.
Their stock is down 25% over the last 12 months.
So they need to.
So they need to do something different, and I guess this is their first attempt at doing that.
You know what's crazy is that Skims was only founded in 2019, so I guess if you're gonna do something right, it doesn't take very long to do it right? So 5 years later, we're looking at a valuation for Skims of $4 billion, which is massive, but it would be a drop in the ocean for Nike. Might they consider an acquisition?
Oh, I mean, Vonnie, wow. I don't know. I mean, that's a good question. That's probably a better question for an M&A reporter.
Yeah, no, I wasn't putting you on the spot. I'm just saying it is
first
something
step towards
that could be considered, right? Or even a partial acquisition. On the other hand, the North Face is also a massive brand, and she did a partnership with them, and apparently that sold out within minutes too.
Wait, what did she sell with them?
Ski wear, wasn't it, Emily?
Skiwear, Skims skiwear?
Skim, like underneath.
North Face Skims?
Yes.
Okay. My producer's saying yes, yes.
I didn't buy any.
Yeah, I didn't buy any of that.
I don't ski. I stick to the safe stuff like the markets, you know what I'm saying? All right, that is Bloomberg's Emily Grafeo. Emily, thank you so much. And coming up, we're going to take you to the closing bell with Dan Suzuki, Deputy CIO of Richard Bernstein Advisors. This is The Close on Bloomberg.
We're in the midst of this economic fog. We're smack dab in the middle. The Fed's going to wait things out. Investors should likely wait things out before making any major pivots in portfolios in response to recent trade actions. But in the meantime, check your headlights, check your brakes, check your exposure. And particularly as market performance year to date has showed, diversification is really the theme this year.
That was Stephanie Aliaga, global market strategist with JPMorgan Asset Management, kicking off the show. She talked about waiting things out, and that's exactly what you're seeing in markets right now.
Yeah, I mean, we're going to get lots to move off. So Nvidia earnings next week. We're obviously going to get more Fed speak next week. We already got some Fed speak today. They all basically said the same thing. You know, hang on a moment. We're going to be keeping rates on hold for now.
Wait and see.
Don't get ahead of your skis, and we'll just see how this economy moves forward. And not just the economy, but obviously inflation. Some troubling signs, though, you have to say, Scarlett, with consumer spending and, you know, consumer delinquencies and so on. There's definitely headwinds out there.
You're definitely hearing that from the companies this earnings season, and we'll wait to hear from the retailers, which will be reporting in the weeks to come. But right now, the S&P 500, though it is in the red, as you pointed out, near that record high.
5 points away from that closing high, can you believe? And, you know, most strategists are looking for 6,500 by the end of the year, so that would not be a very bad outcome for the S&P 500. The Nasdaq as well, down about 0.1%. It looks like there's not much happening today, but what is happening, in fact, is that many stocks are higher, and then just a few like Meta, a few of the important stocks are lower by 3 to 4%. But we're seeing some huge gainers today as well. We'll get into those in a moment. The 10-year yield up 7 basis points, so we are steepening pretty substantially, I would say, relative to the last few weeks. And then Bitcoin took a leg lower in the lunchtime hour. It tried to recover, but it's still below $94,000 a coin right now.
Yeah, we're seeing big swings in the treasury market, but still within that range. So let's bring in now our next guest, Dan Suzuki, Deputy CIO of Richard Bernstein Advisors. And Dan, we have seen more volatility in bonds in the treasury market than in the equity market. The S&P 500 feels like it's been stuck around the same level for a while now. Can't seem to make a new record high. And even when it does, it's just kind of in that range. What does this say about where investors are putting their money?
I think it's really just a function of, I think, you had that clip about diversification. The S&P 500 and equity markets are a little bit more diversified. So, some things benefit from higher rates, some things get hurt by higher rates. With bonds, it's very clear. If you're going to have bigger fiscal deficits, you're going to have inflationary trends, strong growth, all that's going to put upward pressure on rates, and you're going to feel it directly. So I think it's really more of a function of that than in terms about where investors are putting their money. Because at the end of the day, clearly where investors are putting their money is still in stocks.
But we are seeing multiples hit ceilings in those stocks, right? Or in many of them anyway. I don't want to generalize. Can we see further expansion?
I think it gets tougher, particularly in the more crowded, expensive areas of the market, because with rates at higher levels, that's going to pressure multiples. If you have concerns about geopolitical or tariffs or tensions across countries and trade, that's going to pressure the multinationals, which are also those same stocks that have the higher multiples. So I think as a market, it's going to be higher for multiple to go higher. But when you look, going back to the diversification point, when you look outside that one area of crowded, expensive assets, things really aren't that stretched. Energy trades at a single-digit multiple. The rest of the world trades at like a below-average multiple. So, even within the U.S., there's tons of cheap stuff, and so there's where there's opportunity for multiple expansion. Even if the overall market may be a bit challenged.
Yeah, you talked about how investors are putting their money into stocks. The Bank of America investor survey said that investors are long stocks and short on everything else. European stocks in particular are seen outperforming the NASDAQ 100 this year. And there's not a lot of cash that people are holding on to. They're really definitely putting it to work. When we talk about the rest of the world providing more value at this point, how much of that, though, is dependent on what Trump says or does? Because it feels like one pronouncement from him and that trade into European stocks could go the other way.
I think that's right. That's why I wouldn't read too much into sort of this move that you've seen. I mean, what we've learned is that when things are dirt cheap and they've underperformed for so long, it doesn't take a whole lot for those stocks to move higher. But is that move sustainable? I think that's ultimately going to come back to earnings. And the problem for European and a lot of international areas are, earnings are still kind of weak there. So until you see a sustainable move there, I'd be hesitant to chase that.
Dan, how much is this market dependent on next week's NVIDIA earnings?
I don't think it's actually all that dependent, although you're talking about one of the biggest stocks and one of the biggest sort of, stocks that people are watching. It's going to affect market sentiment for the broader tech space. So to that extent, I think that people are going to be watching it. It can drive a lot of near-term volatility. But at the end of the day, the end market you're talking about is very specific.
Right, but it is hard to forget that 20% sell-off that we saw after DeepSeek, right? I mean, 20%, fifth of your money is gone right there.
And despite that, you were talking about almost hitting all-time highs. So the point is that, the market can withstand a sell-off in NVIDIA or one given stock, depending on what's happening with the rest of the market. If NVIDIA is telling you that people are going to stop spending on everything, that poses risk for the market at large. But if it's really anything to do with, just worries about the NVIDIA guidance, about competition, that's more specific to NVIDIA.
I think it's really interesting that as much as everyone's fixated on NVIDIA, some of the old school tech names have really done well. Cisco near record highs, IBM has done incredibly well. Oracle, of course, has been thrown in there with Stargate. When people are broadening away from the Mag 7, but staying in the AI theme, they're going to these like tried and true names that, kind of have been left for dead.
Yeah, I think that's right. I mean, this idea that only 7 stocks were going to be able to grow is just absurd, right? We all knew that, but that's what people were chasing. I think, the more you think about it, is there's going to be a lot of beneficiaries no matter what your theme is. If they are true beneficiaries, then their earnings aren't going to reflect that, and, there's some room for them to run. But, one thing you have to watch out for is, when the market gets really excited about a given theme, what they often do is they price everything to be winners, and that's what gets you into trouble. So not to say that those aren't actual winners, but we know from experience not everybody can be a winner. We've seen this with electric vehicles, 3D printers, solar. Very rarely do all the companies win, and that's what the market sort of tends to price in when sentiment gets a little bit frothy.
All right, Dan Suzuki, as always, really appreciate your joining us. Thank you so much.
Thanks, guys. Appreciate it.
Dan Suzuki, CIO of Richard Bernstein Advisors. So, Vonnie, we talk about how NVIDIA is going to be kind of the big catalyst for the next week. But, the data points that have come across really seem to back up the idea that inflation, although it's not going to show up in core PCE because the PPI and the CPI components seem to show that core PCE is holding up just fine and not necessarily accelerating, it's raising a lot of questions about where we are in the economic cycle.
Yeah, for sure. And will we see that market repricing again, right? It wasn't that long ago that we were pricing only one cut for this year, and now we're pricing in 1+. 50% odds of a second one. So yeah, and more and more people coming out and talking about a hike as well.
Yeah, exactly. Right now, though, the consensus is for about one cut for 2025. All right, we're moving you closer to the closing bell. We've got full market coverage right here on Bloomberg. You want to keep it right here with us.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We are about 2 minutes away from the end of the trading day. Romaine Bostic and Alex Steele are off. I'm Scarlett Fu, and here to take you through the closing bell, we've got a global simulcast. Vonnie Quinn is here, Carol Massar and Tim Stenovic in our radio studio. And we bring together the best of Bloomberg Television, radio, and our YouTube audiences worldwide to parse through the most crucial moments of the trading day. And right now, it looks like kind of an unched day, Carol, when you look at what's going on. But certainly there's a lot of things to keep an eye on, starting with what's going on with Intel.
Yeah, absolutely. We were just talking about Intel. I mean, once again, speculation about whether or not we're going to see some purchasing of their assets. We're talking about Altera in particular, that the company bought about a decade ago. And you've got Intel up, about 16%? That's after a 23% gain last week. So a lot of attention on that one. Certainly one of my gainers today.
I do also want to note that we are waiting to hear from President Trump, who's down in Mar-a-Lago. He's set to speak to the press in just a few minutes. Vonnie, we are going to take those comments live when he does start to speak.
Yes, and I do want to point out as well that not just do we have some earnings after the close, we also have Bill Ackman, the noted former, at least, activist investor, turning himself into a bit of a Warren Buffett these days, making an announcement at 4 p.m. as well.
Into Warren Buffett? I would say no.
I'm sorry?
Can you just turn yourself into Warren Buffett? I would say no.
It's a long process. There's many decades to go before he can say that. But certainly trading in Howard Hughes Corporation is up by a factor of about 5 today. So we'll see what happens there.
All right, well, we'll bring you all the details when they cross. But let's not forget as well, the S&P 500 is near that record high. Vonnie, you've been on record watch. What number are we watching for again?
What was it, 61.18? That was a
61.18. And look at it right now, 61.29 for the S&P 500. That is up by 0.25%. So if it holds, it does look like this could be that record high. Again,
that's even higher than our intraday high.
Yeah, we've been kind of percolating around these levels for a while. Watch on record watch. Again, up 0.25% for the S&P 500. Dow Jones Industrial Average basically unchanged here, up 10 points. The NASDAQ Composite Index gaining about 0.1%. And in terms of the Russell 2000, I almost said 3,000, but that would have been wrong. The Russell 2000 at the moment is also higher by 0.5%. So it is the outperformer on the day, Carol.
Yeah, and fascinating to see some buying into the close here on all of those major equity averages. As for the S&P 500, despite just up 15 points on the day, Scarlett, most names in the index are higher today. 359 actually gaining ground on this Tuesday, 142 to the downside.
Yeah, that late lift in the equity index pushing up a lot of the sectors as well. Let's look at the IMAP. A lot of green there. So let's start with the decliners. Communication services falling, and Meta is a big reason why. I think it ended its 20-day winning streak. Is that right?
Hey, come on.
Oh, okay. Sorry, I'm getting ahead of Tim. Sorry. Okay, I won't say any more. Consumer discretionary and healthcare stocks in the red. Energy, materials, and utilities leading the gains today.
Wow, a little sensitivity there.
Yeah.
All right, let's get to some of the individual gainers. We'll save the decliners for Tim. Intel, obviously, on my list. It is the number 2 gainer in the S&P 500. I believe it's the number 1 gainer in the NASDAQ 100. The stock up about 16% here in today's session. Obviously, we just saw, 20 minutes ago, Silver Lake coming out in exclusive talks to acquire a majority stake in Intel's programmable chips unit. We're talking about Altera. This is according to people with knowledge of the matter. So again, Intel looking to kind of reshape its future, and it's been talking about kind of getting rid of some of its assets. So Intel definitely on the move. Supermicro, I also want to mention that it's up about 17%, 16.5% to be exact. It too is the top gainer in the S&P 500, extending gains for a 4th consecutive session. The company issuing an aggressive long-term revenue outlook and pledged to meet a NASDAQ deadline to file audited financial results. So definitely getting a lot of love here among the bulls on Wall Street on this Tuesday. And then Constellation Brands, it's up about 4% here. Value play, I don't know. It's definitely a stock that's been beaten up. Shares rallying after Berkshire Hathaway reported a new position in the maker of Corona and Modelo. Stock has lost more than 30% in the past year and is down about 20% year to date. So definitely some movement in that one. All right, Tim. All yours.
Oh, cool. You guys see Meta Platforms today?
No, what happened?
2.8%. It finally happened. Nothing is forever. Sometimes stocks go down. Yes, even stock of Meta Platforms. Down 2.8% today, snapping that 20-day winning streak. It's the longest winning streak of any current NASDAQ 100 component, going all the way back to 1990. This is according to data compiled by Bloomberg. The stock gained more than 20% over that exactly that 20-day streak. So keep an eye on Meta Platforms. Robinhood shares falling by more than 7% today. This after a downgrade from Wolfe Research. The analyst Stephen Chubak cut his recommendation on the company to peer perform from outperform. He wrote that much of the potential upside is, quote, already reflected in the stock. I mean, after all, even after today's decline, the stock is still higher by more than 60% so far this year, just this year. And finally, General Mills falling more than 2%. We had executives today at the CAGNY conference down in Florida. Jeffrey Harmening, the company's CEO, said, quote, it's been a volatile couple of months. He cited Nielsen movement data, customer orders, and government, particularly tariffs, said that North American retail has been a, quote, couple of points lighter than expected post the Thanksgiving holiday.
And I just want to point out here that we have had the curve re-steepening. We did see the 10-year yield move up about 7 basis points today, so quite the move, and obviously not as much at the front end for 30 on the 2-year yield. But then towards the back end, we had that whole part of the curve moving higher. So definitely some movement around bonds. We'll get some more Fed speak next week, certainly the ones we heard from today, including San Francisco's Mary Daly saying the Fed is on hold for now. I do also want to mention that Pershing Square news. So Bill Ackman, obviously founder of Pershing Square, has proposed to Howard Hughes Holdings that he would become CEO and then he would raise his ownership of HHH from 37.6% to 48%. And that would be at $90 per share, which would be about a $10 premium from where we traded at the end of the session today, which was already up about 7% once news that Ackman was going to make an announcement had got out there.
Yeah, volume in the stock really skyrocketed today, knowing that this announcement was coming. And the move overall in trading today was a big one, up about 7% on the day.
Yeah, we should point out the stock now down about 4.5% in the aftermarket, right? So, buy on the rumor, sell on the news. So you definitely see it. All right, let's get to some earnings, guys. Crossing the Bloomberg terminal. Arista Networks is reporting as we speak. And let's get to fourth quarter adjusted EPS. It's a beat, 65 cents a share. The street was looking for 57 cents a share. Fourth quarter revenue, too, coming in slightly better, but pretty much in line, $1.93 billion versus $1.9. And here's for the outlook. First quarter adjusted operating margin of about 44%, excuse me. And that compares with 44.3% among the estimate on the street. And I'm just looking at the stock. It is down about 2.4%.
All right, let's take a look at Bumble, which is also reporting as a software company, but, does a lot of the...
Is that what it is?
Yeah.
Oh, I never realized.
Dating, okay?
I thought it was something else.
Online dating apps. All right, Bumble, reporting fourth quarter revenue of $261 million, beating the consensus estimate. Adjusted EBITDA of $72.5 million, also higher than anticipated. Paying users for the fourth quarter, 4.2 million, slightly higher than the expected 4.18 million. In terms of the outlook, first quarter revenue will be at most 248 million. That falls short of the average analyst estimate. And first quarter adjusted EBITDA will be anywhere from 60 million to 63 million. Analysts were looking for 69.3 million. That stock is down about 10% right now.
All right, we're also getting some breaking news. In addition to earnings continuing to cross, we're getting word that a judge has denied a bid to halt Musk's access to U.S. agencies, at least for now. As a reminder, Musk has been hard at work as part of the Department of Government Efficiency, gaining access to certain U.S. agencies in order to cut spending, at least as what he says he wants to do.
Just some more earnings now. Compass actually blowing it out of the park. It looks like revenue of $1.4 billion, beat the $1.34 billion estimate, but adjusted EBITDA of $16.7 million, well above the estimate, almost, more than 1.5 times the estimate for $10.8 million. So again, we're talking in the millions of dollars there in terms of fourth quarter adjusted EBITDA, but it's definitely working for Compass, and that stock right now is up 3.5% after hours.
You know, when I look at all these earnings, I guess the big question I have here is how much they are really able to forecast into the future and how much they're able to say, given that there's so many moving parts when it comes to the outlook, whether it's tariffs, whether it's tax policy, whether it's the M&A landscape with regulation, so expected to be lighter, but so far that hasn't necessarily happened.
All right. And of course, the headlines continuing out of Washington. And we are expecting some comments by President Trump. So I know both on the TV and the radio side, we will continue to monitor. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it The Closing Bell. We'll see you again, same time, same place tomorrow.
All right, coming up on the close, the Brazilian real making big moves this session. We've got a discussion about the tightening in sovereign spreads across the foreign exchange markets this year and how to invest in those opportunities. What's going on with Brazil? This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Bonnie Quinn. And let's take a look at where those markets closed out the session. The S&P 500, NASDAQ, they were all very fractionally changed, but we did see the S&P reach a new high. Not just a closing high, but an intraday high. We haven't seen this level ever on the S&P 500, 61.29. Up 1/4%, but I will say that that was a rally into the close because for most of the session, it was pretty much lower. The NASDAQ also up about 50 points, 1/4%, and some of that was reflected in the earnings post the close, so maybe there was a little bit of anticipation of better earnings. The 10-year yield up 7 basis points, 455, and Bitcoin, wow, look at that rally. We're up $1,000 in the last 15-20 minutes, still down 1.6% in the last 24 hours though.
And let's get you some individual movers. Intel rallying into the close as well. Its biggest advance since March of 2020, up 16% on the day. There's speculation it could be broken up in a deal involving TSMC and Broadcom, and as well, Bloomberg is reporting that Silver Lake Management, the PE firm, is in exclusive talks to acquire a majority stake in Intel's Altera unit, the programmable chips unit. We also want to point out Medtronic down about 7.25%, one of the big decliners in the S&P 500. EPS beat analyst estimates, but organic revenue missed. Customers in its medical surgical division reduced their inventory levels, and that's the reason why the organic revenue numbers did not come in quite as high as analysts had anticipated.
Let's talk Brazil now. A fascinating dynamic going on there. The country offering new debt for the first time in more than 6 months. This all comes amid a broad rally in the country's assets this year. Joining us now to discuss is Olga Yangol, who is head of emerging markets research and strategy for the Americas at Credit Agricole CIB. Olga, thank you so much for joining. This is really a fascinating story because Lula wouldn't have possibly been the most popular leader in financial markets, right? All about the worker, all about the giveaway, all about tax exemptions and so on. Why are markets suddenly liking this administration?
So I actually would say it's not as much administration, the market's liking this administration. One of the factors among a few that have contributed to a rally in across Brazil's assets is Lula's popularity actually going down and disapproval rating going up. Now, that was somewhat of a similar situation to what we've seen in the U.S. Strong economy, yet very high inflation, eating into real incomes. And that was one of the reasons behind Lula's disapproval ratings going up.
But if his disapproval rating is going up, why is the currency doing better? Why are bonds doing better? Why have Brazilian assets made this turnaround in contrast to December when it seemed like everyone was trying to get out of Brazilian assets?
Right. It seems to be quite a turnaround. So there are a couple of things contributed besides Lula, which I get back to that point. So one is Brazil is perceived as a relative winner in the global trade war, relatively insulated from the gyrations given its relatively limited links to the U.S., more diversified trading base, and also relatively closed economy. Another factor has been the improvement in the interest rate differential, with the policy rate in Brazil having increased to 13.25. That is among the highest across EMs. But going back to Lula, the idea is to the extent that Lula is less likely to run in 2026 elections, or Lula's heir is not, likely to do as well, the financial markets would perceive this as a positive. Of course, this is early days, but this is one of the factors that's contributed.
What will Brazil see in terms of fallout if there is indeed a global trade war that sort of ping-pongs around the world?
So in terms of links to the U.S., just 11% of Brazil's exports go to the U.S. China is a bigger trading partner. And not only that, Brazil, as I mentioned earlier, is a relatively closed economy, almost similar to the U.S. It's self-sufficient. So export to the U.S. at just 4 percentage points of GDP. We could see an impact, of course, but then we could also see Brazil's exports being rerouted to the global south, so to speak, like China and other countries.
That all said, and it sounds like an attractive story, but you'd need a risk premium. How do you put a figure on that? What kind of risk premium would you need for Brazil?
So in terms of risk premium, of course, we look at one of the indicators is the CDS, the credit default swap spread, and I would say it's quite low at the moment. It has come down from over 200 basis points at the beginning of the year to just 165 around now. We did see that Brazil's fiscal results did come in within the fiscal rules, and we will see for this year, Brazil is targeting primary balance. We think that is not achievable, but we think that it has a chance of not breaking the fiscal rules. And then in March, we may see some efforts at cutting expenditures and trying potentially improve the fiscal framework. Now, what is the right number? It's difficult to say because we saw Brazil CDUS at 500 back in 2016. So I guess I would just say that at the moment it's a little too low, and we do expect that the Brazilian real will depreciate versus the dollar at least.
So Vonnie started us off by saying that Brazil is offering new debt for the first time in more than 6 months, so returning to capital markets. What kind of demand is there for U.S. dollar bonds, Brazil U.S. dollar bonds? Analysts have said that there is some scarcity value around these products, but who wants to buy them?
Right, and I should say that the CDS is perhaps not the best reflector of Brazil risk because Brazil actually doesn't have a lot of dollar-denominated bonds. It primarily funds itself in local markets.
Right.
So there is a scarcity premium, and that's why Brazil is taking advantage to come to the market right now. Plus, I would say that U.S. Treasury yields have stabilized. There is a risk that we may see them going higher depending on the situation in the U.S.
Yes. Olga, thank you so much for joining us today. Olga Yangol is head of emerging markets research and strategy for the Americas at Credit Agricole CIB. As we mentioned, President Trump is speaking, so we want to bring you to his comments where he is speaking to the press. Take a listen.
Of 25%.
Pharmaceuticals?
It'll be 25% and higher, and it'll go very substantially higher over a course of a year. But we want to give them time to come in because, as you know, when they come into the United States and they have their plant or factory here, there is no tariff. So we want to give them a little bit of a chance. Yes, thank you.
The EU, Andrea Shalal, the EU representative is going to be here in Washington tomorrow. He's going to be meeting with Hassett and Greer and Letnick. What can the EU do to sort of avoid the reciprocal tariffs that you've talked about? And, you've talked a lot about the VAT. Do you expect them to reduce that?
Well, they did already, as I understand it, reduce their car tariff all the way down to what we have. And a lot of that will take place, and I think some won't do it and some will do it. But the EU had a 10% tax on cars, and now they have a 2.5% tax, which is the exact same as us. So already we've saved a tremendous amount. That would be great. If everybody would do that, then we'd all be on the same playing field. Because essentially what we're doing with the tariffs is, they charge us, we charge them, same amount. And it's called reciprocal, actually. And whatever they charge us, we're charging them. And so the EU is I appreciate that they did this, but, the EU has been very unfair to us. We have a deficit of $350 billion. They don't take our cars. They don't take our farm products. They don't take almost anything. They take very little. And we're going to have to straighten that out. And we will. I have no doubt about it. Yeah, go ahead, please.
Thank you, Mr. President. Could you tell us a little bit more about the Russia talks, your impression of how they went today, and if you're perhaps more confident or less confident of a deal after what happened today?
Well, much more confident. They were very good. Russia wants to do something. They want to stop the savage barbarianism. I mean, what's going on over there? It's soldiers are being killed by the thousands on a weekly basis. It's ridiculous. And they're not American soldiers. They're Russian soldiers and they're Ukrainian soldiers largely, although a lot of Koreans have been killed, as you know. Quite a bit of them have been killed. They came over to fight, and a large portion have been wiped out. But we want to end it. It's a senseless war. It should have never happened, would have never happened if I was president, and it's a shame to see it. And I see pictures that you don't see, but I see pictures of fields that look just horrible. It looks like Gettysburg. If you see the old pictures of Gettysburg, it's soldiers lying all over the field, body parts all over the field. They're all dead. And this is going on a daily basis. It's a horrible thing. Both Russia and Ukraine, they're losing thousands and thousands of soldiers, and a lot of people have been killed, too. I think that's one of the things that you'll see historically, and you'll see later on as it goes along. I think people are going to be surprised at how many people, not only soldiers, have been killed in Ukraine. A lot more people than you think. Yeah, please.
President Trump, as part of a peace deal with Putin, would you be willing to consider removing all American troops from Europe?
Well, nobody's asked me to do that, so I don't think we'd have to do that. I wouldn't want to do that. But that question's never really come up. Yeah. Please.
Sir, do you support stationing European peacekeeping troops in Ukraine as part of this peace deal?
If they want to do that, that's great. I'm all for it. If they want to do that, I think that'd be fine.
Even if the Russians are...
I mean, I know France has mentioned it. Others have mentioned it. UK has mentioned it. But, if we have a peace deal, I think having troops over there from the standpoint of Europe, we won't have to put any over there because, we're very far away. But having troops over there would be fine. I would not object to it at all. We're talking about this now, peace. We have either a ceasefire or a peace itself, and we're looking to do both. We'd start off with the ceasefire, and if they want to do that. I know France was willing to do that, and I thought that was a beautiful gesture. Yeah, please.
Do you have any message for Ukrainians who, after 3 years of fighting, might feel betrayed or disappointed at not having a seat at these initial talks in Saudi Arabia?
Well, I think I'm really disappointed in what's happened. I've been watching this for 3 years. It's a war that would have never happened if I was president, and I've been watching these people being killed at levels that you've rarely seen, not even close, since the Second World War. And I'm very disappointed. I hear that, they're upset about not having a seat. Well, they've had a seat for 3 years and a long time before that. This could have been settled very easily. Just a half-baked negotiator could have settled this years ago without the loss of much land, very little land, without the loss of any lives, and without the loss of cities that are just laying on their sides. You have those magnificent golden domes that are shattered, will never be replaced. You can't replace them. 1,000-year-old domes that are so beautiful, you can't replace that. A whole civilization has changed because of what. So when they're worried about not being seated, you mean somebody that should have gone in and made a deal a long time ago. You could have made a deal. This is one that could have made a deal. There was no talk of this during the Trump administration. Putin would have never, ever done it. And by the way, we wouldn't have had October 7th. You know that. We wouldn't have had October 7th either in Israel. And we wouldn't have had that mess that's going on over there. It's like we have great fire people here. We're putting out fires. All over the world, we're putting out fires. So that wouldn't have happened. And you know what else wouldn't have happened? Inflation. Because it was caused really by the cost of energy going through the roof because of their bad energy policies. And And also their spending, their terrible spending, wasteful spending on the Green New scam. It's a scam. It's a whole big scam. Yeah, please.
Yes, sir. I want to ask you a little closer to home. What would it take for you to reconsider the restrictions on the Associated Press? And secondly, some of your advisors are concerned with the Associated Press's style guide, using language and giving guidance to not use words like illegal immigrant or to use phrases like gender-affirming care. And they're concerned about that being an encroaching amount of liberalism in the way in which the press writes about things. Do you share those concerns?
Well, I do think that some of the phrases that they want to use are ridiculous, and I think, frankly, they become obsolete, especially in the last 3 weeks, because many things have happened in the last 3 weeks. And I didn't know about that, but I would say that if they want to use certain phrases like that, and I guess some are okay, but many aren't, but the Associated Press just refuses to go with what the law is and what is taking place. It's called the Gulf of America now. It's not called the Gulf of Mexico any longer. I have the right to do it, just like we have the right to do Mount McKinley, and nobody's even challenging that. But only the essentially, it's primarily the Associated Press, and I don't know what they're doing, but I just say that we're going to keep them out until such time as they agree that it's the Gulf of America. We're very proud of this country, and we want it to be the Gulf of America. Now, the Associated Press, as you know, has been very, very wrong on the election, on Trump and the treatment of Trump and other things having to do with Trump and Republicans and conservatives. And they're doing us no favors, and I guess I'm not doing them any favors. That's the way life works. But, thank you for the question. Who are you with? Very good question. Thank you. Yes.
We're hearing that Russia wants to force Ukraine to hold new elections in order to sign any kind of a peace deal. Is that something that the U.S. would ever support?
Well, we have a situation where we haven't had elections in Ukraine, where we have martial law, essentially martial law in Ukraine, where the leader in Ukraine, I mean, I hate to say it, but he's down at 4% approval rating, and where a country has been blown to smithereens. You got most of the cities are laying on their sides. The buildings are collapsed. It looks like a massive demolition site. So many of the cities. I mean, they haven't done it in Kiev because I guess they don't want to shoot too many rockets in there. They've done it 20%, but they haven't done it 100%. If they wanted to do it 100%, it would probably happen very quickly. But you have cities that are absolutely decimated. And, yeah, I would say that, when they want a seat at the table, you could say the people wouldn't the people of Ukraine have to say, it's been a long time since we've had an election. That's not a Russia thing. That's something coming from me and coming from many other countries also. Ukraine is being just wiped out. Look at what's happening to the cities. There are cities, there's not even a building standing. It's a massive, you talk about Gaza. I mean, it's literally, these cities look like Gaza. Actually, many have, percentage-wise, more buildings knocked down than in Gaza. So, people are tired of it. People want to see something happen. And, the other thing that it's been bothering me for a long time, because I solved the problem with NATO. They paid hundreds of billions of dollars into the funds of NATO when I said, you got to pay, because the United States was paying for European countries, and then they take advantage of us on trade. But I've seen it. Look, they have to pay. They have to find out, where is the money going to? We have, I believe President Zelensky said last week that he doesn't know where half of the money is that we gave him. Well, we gave them, I believe, $350 billion, but let's say it's something less than that, but it's a lot. And we have to equalize with Europe, because Europe is given a very much smaller percentage than that. I think Europe has given $100 billion, and we've given, let's say, 300 plus, and it's more important for them than it is for us. We have an ocean in between, and they don't. But where is all the money that's been given? Where is it going? And I've never seen an accounting of it. We give hundreds of billions of dollars. I don't see any accounting. So I want to see peace. Look, you know why I want? Because I don't want all these people killed anymore. I'm looking at people that are being killed, and they're Russian and Ukrainian people, but they're people. Doesn't matter where they're from on the whole planet. And I think I have the power to end this war. and I think it's going very well. But today I heard, oh, well, we weren't invited. Well, you've been there for 3 years. You should have ended it 3 years. You should have never started it. You could have made a deal. I could have made a deal for Ukraine that would have given them almost all of the land, everything, almost all of the land, and no people would have been killed, and no city would have been demolished, and not one dome.
All right, that is President Trump speaking in Mar-a-Lago, speaking to the press right now. And if you wanted to hear the rest of his remarks, you can type live go on the Bloomberg terminal. In the meantime, I want to bring in now Balance of Power co-host Kailey Leinz. Kailey, the last thing the president said in response to a question about the discussions between the U.S. and Russia on Ukraine is, I think I have the power to end this war in Ukraine. What did we learn from the president in his remarks? And as well, what did we learn in terms of what came out of that meeting between Russia and U.S. officials?
Well, it was interesting, Scarlett, to hear the president characterize Ukraine as having had a seat at the table for the last 3 years as this war has been ongoing, suggesting a deal to end it could have been made sooner. That was in response to questions from journalists around the fact that Ukraine did not have a seat at the negotiating table in Riyadh today when authorities from the U.S. and Russia were meeting for initial negotiations as to how exactly this war will come to an end. We obviously heard the Ukrainian President Volodymyr Zelensky suggest that any deal that is made without Ukraine, he will not agree to. Marco Rubio, the U.S. Secretary of State, did suggest Ukraine and Europe, for that matter, will be brought into these talks eventually, but we didn't necessarily hear the president talking about that there, though he did say that there was good progress made in the talks today, that the talks with Russia were very good. And also interesting to hear him fielding questions on tariffs, Scarlett, obviously one of his favorite subjects. He has floated this notion of auto tariffs going into effect on April 2nd. He has now put a number potentially on what that levy will be, saying that tariff could be around 25%, suggesting it also could be 25% or even higher on pharmaceuticals and chips, two other areas in which he has talked about enforcing these levies. So actually putting some numbers around that today, which was a bit of news from the president, Scarlett.
All right, Kailey, thank you so much for wrapping that up. Bloomberg Balance of Power co-host Kailey Leinz. And of course, you can join her for Balance of Power at the top of the next hour. We did have earnings cross while President Trump was speaking. Toll Brothers, the home builder, announcing results. Let's get you the first quarter numbers. Adjusted home sales gross margin, which is a number everyone's focused on here, 26.9%. Higher than what was anticipated, which was 26.1%. First quarter revenue was $1.86 billion. That comes in lighter than anticipated. $1.92 billion was the consensus estimate. And total home sales for the first quarter, 1,991, also missing analyst estimates. Earnings per share did drop to $1.75 from $2.25 last year. Bonnie, in terms of the outlook, Toll Brothers sees full year deliveries at 11,200 to 11,600. The midpoint of that does miss the consensus estimate of 11,473.
Right, so revenue missed, but certainly on those margins we got a beat, and also the outlook is for a beat as well. So let's get into it. Danielle Hale joins us. She's chief economist for Realtor.com. We're seeing investors punish Toll. We're down to the tune of more than 8% right now, even though margins were what people were focused on apparently, and they beat, and the outlook is for a beat as well, Danielle.
Yeah, I think the challenging thing for builders in this environment right now is what's ahead. And we know that mortgage rates remain elevated. That's going to be a challenge. A lot of what we've seen over the past couple of months in the data, the sales data, has been coming from a time when mortgage rates were lower at the end of 2024, but already mortgage rates are higher. And on top of that, builder confidence, according to the housing market index put out by NHB, shows that builders are a little bit rattled by what's ahead with talk of tariffs potentially raising costs at the same time that mortgage rates are high, which may be dampening buyer demand. So I think the next 6 months is going to be a tricky one for home builders.
You know, the interesting thing is that for the full year, deliveries came in sort of around analyst expectations, but for the second quarter, they missed. Is it possible that we'll see the worst of it before the first half is out, Danielle?
You know, I think it's certainly possible. I think if you look big picture, builders have a huge opportunity. We've been tracking the number of homes that we need in this country that haven't been built, and our estimate suggests it's somewhere between 2.5 and 7.2 million at Realtor.com. So it's a huge gap, and there's certainly opportunities to fill that gap. The really challenging thing for builders is figuring out how to do that profitably in an environment where costs may be going up, labor may be more difficult to come by, and buyer demand may be dampened by these cost factors and affordability challenges that we've been facing for some time that just continue to be a challenge.
Danielle, a lot of people will be listening to the conference call and looking for any kind of commentary that Toll might be able to offer on trends in Texas and Florida, where there's an increased supply in the resale market, which could certainly prove to be competition for a new builder like Toll, as well as giving them an outlook for Southern California, the rebuilding effort there. Can you give us the landscape there in terms of what we might likely hear? What are the conditions for markets like Texas, Florida, and Southern California right now?
Yeah, so in Texas and Florida in particular, we've seen a lot of rebound in the existing home sale market. More sellers are coming to the market and putting their homes on the market. So they are more of a factor for builders. There are more competition from existing home sellers. At the same time, builders have been able to ramp up production and really keep up their share of the market. So I think they'll compete well, especially since builders offer a lot in terms of new construction and the amenities that offers. And builders have been more often willing to offer mortgage rate incentives. So that, I think, will continue to be a factor as mortgage rates remain elevated. Now, as you look to the rebuilding efforts in LA, I think that's going to be a big opportunity. People will want to rebuild in that market. And I think there are opportunities to even reshape the character in some cases of the types of buildings that are built there. So I think that's going to be another area of opportunity for builders.
And I'm so glad you brought up the mortgage rate incentives. We know that the buy downs on mortgage rates has been something that builders have really had to offer to get people to buy those homes and to put in the orders. Toll has said that it's begun to pull back on incentives. Can any of these builders really afford to pull back completely? Because as long as the mortgage rate has a number in the 7% range, that's pretty much anathema for potential home buyers.
Yeah, I mean, we have seen those mortgage rate buy downs become less frequent as I think builders and existing home sellers alike have expected consumers to adjust to these 7% rates. The longer they stick around, the less shocking they are, the more expected they are for consumers. That doesn't necessarily make it any easier for them getting into the market from an affordability perspective, but I do think there is a sense that builders are expecting to see consumers adjust. And as time passes, I think consumers will eventually get in line with that adjustment.
Well, we'll see what tomorrow brings for Toll. Certainly after hours, the stock is down about 7% and year to date down 3%. Danielle Hale is chief economist for Realtor.com. We thank her for joining, Scarlett.
All right. And just a reminder, as we look at Toll Brothers shares fall in the after hours trade, you had a day in which the market had a little bit of a late rally to finish higher. The S&P 500, Vani, closing at a record high, up 0.25%, 61.29, not just on a closing basis, but on an intraday basis as well. And the chip sector really did well. Intel is a clear outperformer today and last week as well. A lot of questions over what's going to happen with this company, whether it's going to be broken up, whether TSMC or Broadcom or Silver Lake, the PE firm, might buy pieces of it.
Yeah, Intel up 16% on a day. When have you seen a stock move that much in one day? Well, I mean, SMCI as well, right? I guess that stock is also cheering and roaring ahead. We're going to get those earnings 2 days after Nvidia's in the Friday session of next week.
And just a reminder as well, steepening of the yield curve again, the 10-year yield moves up to 4.55% and gold at record highs as well. This is the close on Bloomberg. America's interest in what the rest of the world calls football is alive and growing, as evidenced by 30 seasons of Major League Soccer. Opening weekend kicks off this Saturday, and it is an especially exciting season for the league's newest club, San Diego FC, which will play its inaugural game on March 1st. Joining us now for more on this development is Tom Penn. Tom is CEO and co-founder of San Diego FC. Tom, welcome to the close. You co-founded the expansion team LAFC back in 2014. So this is now your second endeavor into the Major League Soccer business. What brought you back to MLS again a second time around?
The city, San Diego, the opportunity. Looking right down the I-5, Southern California, there's no place like this region for soccer. Talent, interest, enthusiasm. And San Diego as a metropolitan area is 3.3 million people with only the Padres as a Major League men's team. So there's great opportunity to bring the 30th MLS club in and to kick off in these next 2 weeks. We open up at the Galaxy on Sunday, the 23rd, and then we're home March 1st. First match ever. Super exciting in San Diego.
All right, so the beginning of a regional rivalry, to be sure. I'd like you to talk a little bit about your limited partners. You have Issa Rae, for instance, as one of the owners there. Talk a little bit about the importance of diversity in your ownership suite, especially given that this is a new club and it's part of the greater LA region, even as it's clearly its own distinct city.
Yeah, we have a one-of-a-kind ownership group. You want to talk diversity, it starts with our majority partners. This is a joint venture with Mohammed Mansour, a multi-billionaire from Egypt, and the Native American Sequan tribe. The original inhabitants of San Diego County are the owners here with Mr. Mansour. You put them together and then bring in a splash of Issa Rae, Thames, who's a Grammy Award-winning African artist, Jocko Willink, who's a former Navy SEAL and a legend here in San Diego, along with Manny Machado, Mr. San Diego, a San Diego Padre star player. We've got a really diverse ownership group across various industries, across races, and it's something that speaks to the essence of our club.
Tom, you know, across all of the MLS teams, we're talking about a valuation collectively of about $21 billion, which on the one hand sounds like a lot, but on the other hand, it's a very limited thing, right? So you could see, you know, a scenario where valuations are just off the charts. What are you doing to ensure that FC San Diego continues to grow and that its valuation becomes more robust?
Yeah, sports are like precious works of art, right? It's like a Monet or a Renoir. There's only 30 of us. And what's important for valuation in sports is revenue. And here in San Diego, we have the opportunity to have a good, strong, robust revenue business. Our stadium has 32,500 seats and great premium seats at Snapdragon. So that is the revenue engine that drives along with sponsorship. Then when you get this kind of fandom, cross-border activity with Mexico in this region. I mentioned the 3.3 million in San Diego County, 2.7 million more across the border in Tijuana. And that border is pretty fluid with a lot of people coming back and forth every day for work, for school, and so on. So we're going to be real value add to the community. And in doing that, you add to this overall value profile of MLS, which is on the rise. I say it's a double rocket booster. You got Messi, and then you got the World Cup. And with those two boosts, we're taking it to a new level in MLS in the next 2-3 years.
You know, you have some great players, you know, Herving Lozano, you know, Anibal Godoy, Andres Reyes. Who might be on your wish list, Tom?
Well, we'll be looking for big star global players. I mean, when Lionel Messi comes to MLS, it opens up the opportunity for so many others.
He's a little busy right now.
Yeah, no, I know. We're not going to get him, but somebody like him, some other stars from the world look at MLS as a league of choice now. And you mentioned Chucky Lozano. He's the most famous player in Mexico, the star of the Mexican national team in his prime. That's our marquee player. He is beloved in this market and nationally and on this continent because of the success he's had with their national team.
I want to ask you about Apple's role in growing the game of soccer in the U.S. Apple, of course, with this relationship with the MLS to distribute the games. It was a 10-year partnership, definitely has improved broadcast quality and accessibility. But at the same time, there's some criticism that perhaps it's limited the league's ability to grow its audience. What's your take here?
We've gotten consistency of programming and consistency of an offering. You know it's Saturday Night Soccer on Apple TV, and then they're adding a Sunday night feature event. It'll be the marquee matchup, sort of like Sunday Night Soccer instead of Monday Night Football. It takes a little while to build that kind of audience, habituate the audience to go there, but there's no better company to be partnered with globally than Apple. And this is taking all the rights, the local rights, the national rights, the global rights, putting them in one package with the biggest company on the planet that's all focused on entertainment as well. So you put that all together, there should be a great growth opportunity for this partnership with MLS and Apple, both domestically and globally.
Okay, so you've solved distribution of games with Apple, at least for the next 8 years going forward. What about sponsorship opportunities for the league that haven't been tapped into yet, that you'd like to see be tapped into over the next couple of years?
You want to always grow sponsorship, both locally and at the league level. Good progress in all areas there. It all comes down to interest and eyeballs, right? How much do people care about this league? How top of mind is it? That's really where the World Cup comes in. The fact that that amazing global event is coming to North America. It's going to be right in our front yard, backyard, side yard, everywhere. It should captivate the attention of America. We should all fall more in love with the global football and then realize that MLS is here week in and week out. And it's a wonderful expression of the sport, not only the quality of the play on the pitch, but the avid supporters that have flags and sing the entire time in the end zone. That's what hits you in the heart. That's what you remember. That's what people want, is an entertainment experience around a game that the rest of the globe adores.
Tom, any conversations surrounding potential TV programs about the behind-the-scenes drama or anything like that? I mean, it worked really, really well for the NFL, right?
It's happening, yeah. We got a great series that's coming. Box to Box is producing it, and it's a full behind-the-scenes feature on the entire league. They follow the best stories going on. They're going to be tracking our player, Chucky Lozano, this Mexican star. They've already been embedded with him and his transition from Europe into San Diego. Now see how he performs and what that's like to sit in the car with him at his home with his family, in the locker room, so on and so forth. That's all in production.
Tom, you mentioned the World Cup. Of course, that's going to be in about a year and a half, just under a year and a half, June of 2026. I think about how Canada, Mexico, and the U.S. will be hosting the World Cup. Relations between these three countries is not great right now. And you look at what happened at the NHL Four Nations tournament, people in Canada, in Montreal, booing during the Star Spangled Banner. Are you concerned about perhaps relations not improving to the point where that gets in the way of the hosting of the World Cup?
Hadn't thought about it. Nothing's going to get away in the way of hosting this World Cup. It's coming, and it'll be magnificent. It'll, by definition, be collaborative and cooperative, because that's what sport does, is bring people together. You know, I hadn't thought about, you know, the current nature of what's going on and how that's going to change and morph, but I have to believe in a year and a half it's going to feel dramatically different than it does right now. What direction? I don't know. These are global factors, global events, international relations. But what I can tell you is that there's been great cooperation at the federation level of each of these countries, and then up at FIFA and CONCACAF, which is our region. And it takes that kind of coordination along with the MLS, because we operate so many of these venues or in each of these markets. We need to all be aligned to just host the entire world and put on a magnificent event.
Thank you for answering that. And Tom, before I let you go, I got to ask you about the Right to Dream Academy, because every football club has to have their own pipeline of talent.
Yeah, this is the secret sauce for us. Right to Dream is a family, a community of youth academies. Started in Ghana 25 years ago, grew up into Denmark, so mixing the best sub-Saharan talent with the best Scandinavian talent, and then Sir Mohammed Mansour invested in Right to Dream and took it to Egypt. And from Egypt, go to America, because America gets this. So what do? We're going to find the best 10, 11, 12-year-old players and make a full scholarship investment in those players, boys and girls, in their development. Those that go on the professional pathway will come right into our pipeline and go on to play at other clubs.
Right.
Half of the kids, they'll go on to scholarship at the best prep schools and college. So you get an academic pathway, a professional pathway, full-on commitment, and it could change the face of development in North America.
And it goes back to that idea of, again, sport unifying all of us. Tom, really appreciate your joining us today. Thank you so much. Tom Penn, CEO and co-founder of San Diego FC, the newest MLS club. Still ahead, we're going to give you a preview of what to watch for over the next 24 hours, including tomorrow's Apple event. This is Bloomberg.
Tomorrow is the big day for Apple, which is set to bring in a quote-unquote new member to the family. Here with more on what Apple has planned is Mark Gurman, Bloomberg News Chief Technology Correspondent. I mean, I guess I got to ask, boy or a girl?
That's so funny. Well, Neither, just a budget iPhone.
Non-binary.
Yeah, a new low-end iPhone. It's going to replace the iPhone SE. The iPhone SE, they originally launched that in 2016. The idea was to give consumers something smaller. Right, by that time they had the 6 Plus, the 7, the Pro phones, the bigger devices. People wanted something smaller, but they also wanted something cheaper with the new guts inside, newer battery, newer technologies. But that phone sort of drifted away. It now has a really aged design.
Yeah.
So now it's going to look like the iPhone 16, have new features like Apple Intelligence, Face ID. It's going to remove the home button finally. But it's going to probably be about half the price of an iPhone 16 Pro. And for a lot of people, that's going to be pretty compelling, especially in emerging markets.
There are people who definitely want that home button still. So what's the price point here for the new budget iPhone?
So the iPhone SE, when it first went on sale, it was south of $400. Now the current version is $430. This one is likely to be $500 or more because you're replacing the home button with Face ID. It's a much more expensive component. You have a better camera in there, a 48 megapixel camera on the back. But you also have Apple Intelligence, which requires more processing power and more RAM inside as well.
Is there a risk that Apple's whole suite of products is getting a little bit more complex and complicated now again? I mean, at one point there were too many Apple products out there, right? And Steve Jobs had to axe many of them. Are we getting there again?
It's getting a little complicated, and it's going to get even more complicated over the next 2 years because now they're replacing the SE with this new replacement, with this new budget phone, sort of a cheaper 16. Then in the fall, right, you're going to get 4 new models, and one of them is going to be an entirely new model. This is sort of a slimmed down, thinner version. And then next year, they're going to add a foldable version to the line. So you're seeing an entire family here now, and it's for a reason. He's calling it a family because it's a family that's getting bigger.
What's the market for this new budget phone? I mean, when you talk to people, are they saying that Apple needs a new budget phone?
Well, the newest phone, right, is $700, $800, $1,000 for the Pro models, right? That's a lot of money for a lot of people, and even with installment plans, that puts it out of reach. This is going to be able to reach so many more people now at that half the price of a Pro phone.
It's all about bringing people into the ecosystem still, isn't it, really?
No, it's all about just updating people or giving people a phone that at the same price point but with better battery life.
That too.
All right. Mark Gurman, always a pleasure. Thank you so much. Bloomberg's Mark Gurman, our go-to guy for all things Apple on the new Apple device.
I feel like we're all Apple experts. We always feel like we are.
Yeah, right? Well, because if you have a phone that you spend $1,000 on, then you're an expert.
I didn't. I got a deal. I got the cyber whatever deal, and I bought a laptop as well. But then, of course, they got me to buy a laptop too. So
we all get
maybe I didn't get a deal in the end.
All right, that does it for us, everyone. Balance of Power is up next. They'll wrap up everything that's happened in geopolitics, in particular the talks between the U.S. and Russia and Saudi Arabia. Have a great evening, everyone. This is Bloomberg.